The mask has finally slipped. Just over an hour ago, the Federal Reserve released the minutes from its January meeting, and the message between the lines is loud and clear. The system is no longer a monolithic machine of control. It is a fractured, desperate entity. I'm your host, and you are watching Analysis with AG. We are entering a phase of the market where the narrative is colliding head-on with the mathematics of reality. While the talking heads on financial news networks try to soothe you with talk of a soft landing, the gold and silver markets are screaming a different story. In the last 60 minutes, we have seen a $55 explosion in the price of gold. We have seen silver surge $3. This is not a random fluctuation. This is a structural awakening. They want you to believe that everything is under control. They want you to believe that the Fed is a united front, calmly navigating the economy toward stability. But the minutes tell the truth. The word of the day is divided. For the first time in this cycle, the internal consensus has shattered. The doors are locking, the exits are narrowing, and the people running the printing presses cannot agree on which way to turn the wheel. This is the moment we have been waiting for. This is the beginning of the Great Divorce. Let's look at the raw data because the numbers do not lie, even when the bureaucrats do. Yesterday, gold closed at $4,938. As I sit here now, it is trading at $4,993. That is a vertical move. Silver has jumped from $74.40 to over $77. In the world of precious metals, these aren't just price movements, these are seismic shifts. And they happened in a vacuum of liquidity while the massive Chinese markets are still shuttered for the Lunar New Year. Think about the implications of that. The biggest physical buyers in the world are offline, yet the price is detonating. The mainstream narrative is that the Fed is hawkish. They kept rates steady at 3.5 to 3.75%. They talked about the resilience of the economy. If you only read the headlines, you would expect gold to be cratering. You would expect the dollar to be an untouchable fortress. But look at what actually happened. Treasury yields spiked. The 10-year yield climbed to 4.087%. Usually, when yields go up, gold goes down. That is the standard algorithmic trade. That is what the bots are programmed to do. But today, the bots lost. Gold ignored the yields. Silver ignored the bond market sell-off. This is the divergence that signals a regime change. The market is starting to realize that a divided Fed is a paralyzed Fed. If you're finding value in this real-time intelligence, you need to understand that the algorithm does not want you to see this. It wants to bury this data under a mountain of distractions. Roughly 75% of you watching right now are not subscribed. If you want to stay ahead of the curve, if you want the breakdown of the Comex delivery crisis that is now only 9 days away, hit that subscribe button. Drop OG John AG in the comments right now. That is how we fight back against the suppression of these facts. That is how I know you are locked in for the chaos that is coming. Why did gold rally $55 in the face of rising yields? Because the market saw the word divided and recognized it as a white flag of surrender. When the Fed is united, they have the power to jawbone the markets into submission. When they are divided, they are toothless. The minutes revealed that while they agreed to hold rates in January, there is no consensus on the path forward. Some officials are terrified of staying too tight for too long and crashing the labor market. Others are terrified of easing too soon and letting inflation regain its foothold. This division means the Fed is no longer leading the market. They are reacting to it. And the market knows that when the Fed reacts, they usually react too late and too heavily. There is another factor at play here that the mainstream media will never mention: the lease rates. This morning, before the FOMC minutes even dropped, silver lease rates in London spiked to 6.3% for 1-month borrowing. For the uninitiated, a lease rate is the cost to borrow physical metal. When that number spikes, it is a siren in the dark. It means someone, somewhere, needs physical silver desperately and they are willing to pay a premium just to hold it for 30 days. This is a signal of extreme physical tightness. We are seeing backwardation confirmed. The physical price is decoupling from the paper promise. We are now exactly 9 days away from the March 1st notice day on the Comex. This is the moment of truth for the shorts. The math is staggering. There are currently 1.2 million ounces of silver in the registered category on the Comex. These are the ounces available for delivery. Against that, we have an open interest of 366 million ounces for the March contract. Do the math with me. That is a ratio of 3.59 to 1. For every 1 ounce of silver sitting in the vault, there are nearly 4 paper claims demanding delivery. Usually, the big banks and the bullion dealers can talk these contract holders into rolling their positions forward to May or July. They offer them a little bit of a premium. They use some high-frequency trading to scare the price down, and the longs fold. But look at the environment we're in today. Gold is at the doorstep of $5,000. Silver is surging. The Fed is admitting they are divided. If you are an industrial user, if you are a manufacturer of solar panels, electronics, or medical equipment, and you see the physical market tightening and the Fed losing control, do you roll your paper contract, or do you stand for delivery? Do you take the metal while it's still there? Today's $55 gold rally changed the psychology of the entire market. If gold had crashed on these minutes, the longs would have panicked. They would have rolled their contracts, and the squeeze would have been delayed. But the rally gave them backbone. It gave them a reason to believe that the price is headed significantly higher. Every dollar that gold and silver climb between now and February 27th makes a delivery event more likely. We are watching a game of musical chairs where the music just slowed down and everyone realized there are only a few chairs left for dozens of players. Let's talk about the bond market for a moment, because this is where the confusion is rooted. The 2-year yield and the 10-year yield both rose after the minutes. Bond traders are looking at the Fed's division and they are pricing in uncertainty. They're saying if the Fed doesn't know what they're doing, we're going to demand a higher return for holding their debt. This is a hawkish signal for bonds, but it's a vote of no confidence in the currency. Gold is the ultimate barometer of confidence. When gold rallies alongside yields, it means the market is no longer worried about the cost of money. It is worried about the return of money. It is worried about the systemic risk of a central bank that has lost its internal compass. Tomorrow is a critical junction. At 8:30 a.m. Eastern, we get the initial jobless claims data. This is the next piece of the puzzle. If those claims spike, it validates the dovish faction of the Fed. It proves that the labor market is finally breaking under the weight of these rates. If that happens, gold doesn't just test $5,000. It blows right through it. We could see $5,050 or $5,100 by the weekend. Silver would likely target $78 to $80 in that scenario. However, we must remain objective. This is not a one-way street. If the jobless claims come in low and the labor market looks resilient, the hawks will regain their footing. We could see a sharp pullback as the algorithm reasserts itself. Gold could drop back to $4,900 just as fast as it climbed. This is why you must invest with logic, not hype. We are in a high volatility environment where thin liquidity can move prices violently in either direction. The return of China next Tuesday is the elephant in the room. The Shanghai Gold Exchange has been closed for 8 trading days. When they left, gold was over $5,000. They're coming back to a market that has been through a roller coaster. If the Chinese investors see this Fed division as a sign of dollar weakness, the buying pressure on Tuesday could be historic. They are the world's largest physical buyers, and they don't care about the Comex paper price. They want the bars. They want the coins. They want the security of physical assets. We also have to watch Hong Kong this Friday. They reopened before the mainland. Their price action will be the first indication of how the Asian markets view this FOMC release. If Hong Kong opens strong and stays strong, it confirms that the smart money in the East is buying this rally. If they sell into it, we might be looking at a temporary top before a deeper consolidation. But let's go back to the physical reality of the silver market, because that is where the real drama is unfolding. We are seeing a great divorce happening in real time. On one side, you have the paper markets, the comms, the LBMA, where billions of dollars in digital contracts are traded every day. On the other side, you have the physical market, where industrial users are struggling to find supply and lease rates are hitting 6-year highs. Yesterday, we saw a massive headline. Wheaton Precious Metals paid $4.3 billion for silver at an effective price of $72 an ounce. They are locking in multi-year supply deals because they know the spot price is a lie. When the world's biggest players are bypassing the exchanges to secure metal at a premium, you know the exchange is broken. The 65 minutes following the FOMC release were just a symptom of this underlying rot. The price is trying to find its true value, and the true value of an ounce of silver is not $77 when there are 4 people claiming every ounce in the vault. If you are holding physical metal, today was a victory, but it wasn't a reason to sell. You don't sell your insurance policy when the fire starts. You hold it tighter. The $55 move in gold is just a number on a screen for you. The real value is the fact that you have removed your wealth from a system that is currently admitting in its own bureaucratic language that it is divided and uncertain. For the futures traders, the landscape is much more dangerous. If you were short going into today, You just got a brutal lesson in why you don't bet against gold in a period of systemic instability. Your stop losses should have been triggered at $5,000. Do not be a hero. Do not try to fight the momentum of a market that is ignoring rising yields. If gold closes today above $4,980, the technical rising wedge pattern that the bears were counting on is officially dead. The bulls have reclaimed the narrative. The psychological level of $5,000 in gold is the line in the sand. We are $7 away. $7. That is a rounding error. When we break 5,000 and stay there, it changes the entire global conversation. It moves gold from a commodity to a currency in the minds of the public. It triggers a FOMO fear of missing out that can drive the price to levels that seem impossible today. And silver? Silver is the high beta play. When gold moves 1%, silver moves 3%. If gold hits 5,050, silver is going to be knocking on the door of $80. At $80, the industrial users who are waiting for a dip to $70 will realize the dip isn't coming. They will rush to the Comex to stand for delivery before the vaults are empty. That is how a squeeze begins. It's not a slow process. It's a sudden, violent realization that the supply is gone. This is why I tell you to watch the lease rates, 6.3%. Keep that number in your head. It is the most important data point in the market right now. It tells you that the paper price is failing to draw out physical supply. It tells you that the arbitrage is broken. In a healthy market, a high lease rate would be quickly brought down by people selling physical to capture the premium. But nobody is selling. They are hoarding. They are protecting their positions. We're 9 days from the beginning of the end for the March silver contract. Between now and then, every piece of economic data, jobless claims tomorrow, GDP revisions on Friday, PMI data will be filtered through the lens of this divided Fed. The market is looking for any excuse to believe that the Fed is done, that the pivot is coming, and that the dollar is entering a period of structural decline. The algorithm wants you to think this is just another day in the markets. It wants you to focus on the next celebrity scandal or the next political drama. But the math of the Comex and a division of the Fed are the only things that matter for your financial future. We are witnessing the breakdown of a decades-long regime of paper dominance. The physical world is reasserting its authority. I want you to look at your own positioning. Are you prepared for a world where gold is $5,000 and silver is $100? Are you prepared for a world where the Comex has to settle in cash because they don't have the metal to fulfill their obligations? This isn't fear-mongering. It's a mathematical possibility when the ratio of claims to metal is nearly 4-to-1. Today was a warning shot. A $55 rally in an hour on mixed minutes is the market telling the Fed, we don't believe you anymore. The bond market is selling off because it's scared. The gold market is rallying because it's prepared. Which side of that trade are you on? Tomorrow morning at 8:30, the next battle begins. I will be here to break it down. I will be here to show you the numbers that the mainstream media ignores. If you haven't already, subscribe to the channel. Let's get that 75% of non-subscribers down to 0. We need a community of informed, logical investors who can see through the hype and understand the structural shifts occurring in our global economy. Comment OG John AG if you stayed with me this far. It tells me you're part of the core group that understands the gravity of this situation. You're not here for the quick fix or the moonshot promise. You're here for the real-time market intelligence that allows you to protect your family and your wealth. The doors are locking. The vault is emptying. The Fed is divided. The algorithm wants to bury this, but the math is undeniable. We are 9 days away from a potential reckoning in the silver market. We are $7 away from a historic milestone in gold. Stay sharp. Stay logical. Do not let the volatility shake you out of a structural position. The great divorce is here. The paper world is burning, and the physical world is the only place left to hide. We will see what the jobless claims bring in 16 hours. Until then, watch the $5,000 level on gold like a hawk. Watch the $78 level on silver. And most importantly, watch the lease rates. They are the heartbeat of the physical crisis. This is a time for conviction, not hesitation. The Fed has shown its hand, and it's a weak one. The market has responded, and it's a strong response. The countdown to March 1st is on, and the pressure is building with every passing hour. I'll be back with the next update as soon as the data drops. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly, including me. Look at the numbers, look at the math, and make your own decisions. The system is fracturing, and only those who can see the cracks will survive the collapse. OG out. Wait, we aren't finished. We need to look deeper into the why of this Fed division. Think about the individuals sitting around that table in Washington. They are looking at the same data we are, but they are blinded by their own models. They see a resilient economy because the unemployment rate is technically low. But they are ignoring the quality of those jobs. They are ignoring the fact that the average American is drowning in credit card debt and that the manufacturing sector has been in a slump for months. When the minutes say they are divided on what happens next with monetary tightening, what they are really saying is that they have no idea if they have already broken the system. They are flying a plane in a thick fog, and half the cockpit wants to climb while the other half wants to descend. That is a recipe for a crash. And gold is the ultimate insurance against a pilot error. The rally we saw today, that $55 surge, was the market pricing in that pilot error. It was the market saying the Fed's indecision is the greatest risk of all. If they stay too tight, they cause a deflationary collapse. If they ease too soon, they trigger hyperinflation. There's no longer a middle path. The soft landing is a myth that died in the January FOMC minutes. Now consider the industrial demand for silver. We often talk about silver as a monetary asset, which it is. But it is also an essential industrial metal. In a world moving toward electrification and green energy, silver is non-negotiable. There is no substitute. If you were a CEO of a major tech company and you read that the Fed is divided and silver lease rates are at 6%, you don't wait for the price to drop. You call your procurement officer and you tell them to secure every ounce they can find, regardless of the cost. This is the hidden squeeze. It's not just retail investors buying silver coins. It's the giants of industry realizing that the supply chain is about to break. If the Comex fails to deliver in March, it won't just be a financial headline. It will be a supply chain disaster for some of the biggest companies in the world. That is why the stakes are so high. That is why the $55 gold move is just the beginning. We are watching the end of the algorithm era. For years, the bots have ruled the markets. They sold gold whenever yields rose. They bought the dollar whenever the Fed sounded hawkish. But today, the physical reality overrode the digital programming. The bots tried to sell the yield spike, but the physical buyers stepped in and absorbed every ounce. This is the shift from a paper-driven market to a physical-driven market. In a paper-driven market, the price is whatever the biggest bank says it is. In a physical-driven market, the price is whatever the person holding the metal is willing to sell it for. And right now, nobody is willing to sell. Not at $77, not even at $80. We are entering a period of price discovery that will be violent, chaotic, and ultimately very rewarding for those who held through the manipulation. As we move toward tomorrow's jobless claims, remember that the truth teller persona isn't about being right all the time. It's about looking at the data that everyone else is too afraid to touch. It's about calling out the division in the Fed when the media calls it flexibility. It's about calling out the delivery crisis when the exchange calls it liquidity management. Don't let them gaslight you. The math of 3.59 to 1 on the Comex is a fact. The 6.3% lease rate is a fact. The $55 rally in gold is a fact. These aren't opinions. These are the pillars of the new reality. If the jobless claims come in weak tomorrow, the floodgates will open. The $5,000 level in gold will be a memory. We will be looking at a new paradigm. If the claims are strong, we get a temporary reprieve, a chance for the latecomers to get positioned before the China return on Tuesday. Either way, the trend is established. The Great Divorce is accelerating. Take a moment to look at your strategy. Are you distracted by the day-to-day noise, or are you focused on the 9-day countdown? Are you watching the ticker, or are you watching the vaults? The OG gang knows the answer. We watch the math. We watch the physical. We watch the truth. The algorithm is trying to steer you away from this. It wants you to click on something mindless. Don't let it. Stay here. Rewatch the sections on the Comex ratio. Understand the implications of the Fed's internal war. Share this video with someone who still thinks their paper savings are safe. We have 9 days to spread the truth before the March 1st notice day. This is Analysis with AG. We don't do retroactive analysis. We don't tell you what happened yesterday as if it's news. We give you the intelligence you need to survive tomorrow. The $55 rally was just the opening act. The main event is coming, and it starts with the jobless claims in 16 hours. Stay locked in. Stay skeptical of the narrative. And most importantly, stay physical. The paper world is losing its grip, and the physical world is coming to collect its due. I'll see you in the next one. Invest with logic, not hype. OG out.